Hi there everybody and welcome back to the stock analysis video. Today I would actually like to analyze the company YETI. They did have their earnings as of Wednesday morning and I haven't done this company, so you know what? I figured let's actually analyze this company and see if their fundamentals actually match their current share price. So with that said, let's get started with this analysis. We are going to jump right into the calculator, ticker symbol of YETI, YETI, market cap of almost $4 billion with a PE of 18.89. This means that in accordance, guys, to my standards of anything less than 20, which is what I personally like to buy things at, anything less than 20 PE, this means that this current share price of $45.30 might actually be fairly decent price to buy it at. Now, does this mean that we absolutely buy it? Absolutely not. Let's take a look at other metrics to see what we can actually come up with. Now, they do not pay a dividend, which means that their 5-year average free cash flow, or just their cash flow in general, is going into themselves to pay down their debt, to make acquisitions, to buy back shares, and to reinvest in themselves. Let's take a look now at some fundamentals, starting with a net income 5 years ago of $15.4 million to 1 year ago of $212.6 million. Guys, that's an increase of 1,281%, which is actually fairly good. Now, we see here something very interesting is that from 5 to 4 to 3, pretty stagnant around like the $55 average, right? $55 million average, sorry. And then 2 years ago, they just completely skyrocketed all the way up to 155.8 million. Then obviously 1 year ago, 212. Now, what could cause this? Probably COVID, right? But then again, I'm not fully certain as to how COVID played a role into this. Now, they do make products such as the YETI cooler that helps preserve food, and since people were probably going out, maybe a lot of people used YETI coolers to keep their food in. That's as far as I could get. If any one of you guys have an idea as to why they skyrocketed this much 2 years ago, then by all means leave it down in the comment section below. But nonetheless, this is still a fairly great increase when it comes to their net income. Taking a look now at the cash flow, guys, the lifeblood of the company, cash from operations less your capital expenditures. This is actually very interesting because, well, it's not really that good. 5 years ago of $105.6 million all the way up to 1 year ago of $90.4 million in their free cash flow. This is a decrease of 14%, and this means that they have a 5-year average free cash flow of $151 million. Now, obviously right here the big elephant in the room is, again, 2 years ago they just skyrocketed. Again, COVID, and the reason why I think this may happen is because, as I said when I started with the free cash flow, is this is cash from operations less your capital expenditures. They probably had a lot less capital expenditures, which probably increased their cash flow. So as it stands, this is very erratic, and it's not that good, right? You have one outlier, great, but that doesn't mean that this outlier makes the actual cash flow actually good, right? This is the exception, not the rule. And the rule so far right now is that they're hovering at around maybe like, I don't know, the $100 million mark or so, which is really bad, seeing that, they went from what, 105 to $90 million within the past 5 years. Taking a look now at the revenue, we got 5 years ago of $639 million to 1 year ago of $1.4 billion. That's an increase of 120.74%, which is really good. This is exactly what I wanted to see when it came to the other two metrics, right? A nice steady increase. We are seeing this in the revenue. However, this right now is essentially 2 out of 3 metrics that aren't like this, at least when it comes to their profits. Their income is fine. However, can they continue their income growth like that? I don't necessarily know. The free cash was all over the place, and this was the one that's only steady enough for me to say they might be able to continue this into the future. Taking a look now at their total assets minus their total liabilities. If they were to liquidate all of the assets, would they be able to cover their liabilities, and by how much? Currently, they can't do this at $456 million that they would have left if they were to do so. However, something to note here is that 5 years ago, they were in the red by negative $76 million. And, this only lasted for 1 year. I wish I had more data in the past to see what the trend was. Maybe this was just an outlier. Maybe other years they were positive, like 6 years ago they were positive. But nonetheless, this is still in the red. And 4 years ago, they did go up to 29, and then they continued to increase it ever since. Nonetheless, it is still an increase. My biggest concern is this 5 years ago number that they cannot cover their liabilities. Average total assets around $743.85 million. Average total liabilities around $522.62 million. Doing the average assets minus the average liabilities, we get $221.23 million. Taking a look now at the metric that companies like these always tend to fail, and I do not know why, we're going to take a look at the shares outstanding. This tells you whether or not the company is diluting you as the investor. By issuing more shares, they are diluting you as the investor. They're giving you a smaller portion of their own company. If they buy back their own shares, by default, they are automatically increasing the value of the shares that you already have. So we got 5 years ago of 81.5 million shares to today, guys, of 87.4 million shares. That is an increase in the 5 year of almost 7.25%. Now, from the previous year to the current year, we are looking at 1 year ago to today. They brought back around 0.34, which is good. However, it's not good enough to offset this 7.24% number from 5 years ago to today. And lastly, cash equivalents. They have around $100 million in cash and codes with an average cash of around $145.35 million. Now let's make some assumptions: low, median, high. As always, 3 different factors: revenue growth, projected share buyback, and required rate of return. Revenue growth, guys, I'm going to be looking at Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, and making a conservative assumption. Okay, that's why if you were to actually see Seeking Alpha's numbers, they're significantly higher than mine, but I'm doing that for a reason, because I want to be as conservative as possible. For the predicted share buyback, I'm going to be using the shares outstanding graph that we just saw, taking a look at past precedent to essentially come up with future precedent. And for the required rate of return, I'm going to be using 10% to match the S&P 500. So for my lowest assumption, let's say a growth of 12%, predicted share buyback of -6%. This comes out to be $68.29. For my median assumption, a growth of 15%, predicted share buyback of -4%. This is $76.76. And for my highest assumption, 18% revenue growth, predicted share buyback of -2. We come up with $86.12. Now let's actually adjust for debt. This is why we take a look at the cash equivalents, because we take the cash equivalents and we add the net debt. If they have more net debt than cash, then this number would actually come down. And if they have more cash than debt, then this number comes up. You can see it does come up by a little bit, by around 20 cents or so, 21 cents or so. So for my lowest assumption, it is now $68.50. For my median assumption, it is $76.98. And for my highest assumption, it is $86.34. Now let's add a margin of safety of 5, 10, and 15%. And the reason why I like to do this is because I want to be even more conservative than that of my assumptions. The more you pay for something today, guys, the less returns you're going to have in the future. You want to make sure you have all your bases covered. So adding this margin of safety for the low assumption, I personally would like to buy between $58.23 to $65.08. For my median assumption, it is between $65.43 to $73.13. And from highest assumption, it is between $73.39 to $82.02. Now the current share price, guys, is $45.30. So as it stands, this might actually be a pretty decent buy if you believe my assumptions, right? However, as I always say in every single video, you have to be able to believe my assumptions for this to actually occur. That's why I have this calculator available for free. Anybody could have it. It's the same thing with my book value as well as a dividend tracker, giving out these free things because I want you guys to make your own assumption. Every investment is the present value of all future cash flow. This is not financial advice. So what I want you guys to do is to make your own assumptions and see where you would actually land at. For example, let's say that, I don't know, you think that YETI might grow at like 29%, just like Seeking Alpha says, around 29%, and you think that they're going to start buying back shares at around, let's say 2%. Well, as it stands right now, that would be a target share price of $125, right? So this really does affect how much you would actually be willing to pay for something. That's why, again, I have this calculator. It's in my calculators playlist. There's a link in the description. You go in there and you essentially just make a copy and you put in the numbers that you so wish to do so. All I'm asking for in return, guys, for this 3 free things, this calculator, a book value calculator, and a dividend tracker, is please help me grow my channel. We are really, really close to 600 subs. That's awesome. Thank you all so much. Thank you all for watching. And I'm giving out these free things. All I'm asking for is 30 seconds of your time to just help me grow my channel. All in all, when it comes to YETI, this is actually a fairly interesting company. Very niche product, right? For starters, very niche product. I mean, it's not anything something that people can't live without, right? It's pretty outdoorsy as well. So I do think that when things hit the fan, I don't think that this company will be priority for people, right? That's kind of my whole thing. And I think that they're actually going to drop a little bit further, if anything, right? Assuming that things get worse. Now, would I personally buy this? Well, they don't pay a dividend, so it kind of is already off my wheelhouse. However, maybe for a growth portfolio, if you believe that this company is worth what my assumptions were, then by all means, this is an absolute buy right now. But again, not financial advice. That's pretty much it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. As I said, you guys can follow me on my new tech sites at BitChute, Odyssey, and Rumble. All links in the description below. Also have a Let's Play channel. Also, the link is in the description, so if you want to follow me there, you can follow me there too. With that said, peace out, and I will see you all in the next stock analysis video.